today's video, we are going to be talking about several aspects of price action trading involving expanding pivots, the Andrews pitchfork, mirror lines, market manipulation, and a lot more. We're going to analyze some interesting details on this 1 hour time frame Euro-USD chart. The first thing we want to notice here is that between number 1 and number 4, we have higher highs and higher lows in what's called the major flow of the market. Higher highs and higher lows imply an uptrend because buyers are powerful enough to progressively rise the market with each high and with each low. And of course, sellers are not powerful enough to prevent that behavior. In other words, when we see higher highs and higher lows, we can assume, at least for the moment, that buyers have dominance over sellers. The direct consequence of that is the creation of a demand zone around low number 3. Under normal conditions, price would return to the demand zone, and then it would be catapulted back to the upside to create a new higher high. But that's only in theoretical terms. In reality, the market tends to be a little more complicated and nuanced than that. Things start to shift a little bit between number 5 and number 6. Notice that instead of returning back to the demand zone in number 3, price simply makes a shorter retracement and then rises once again to break the level of high number 4. One interesting detail here is that the volatility from the 4-5 vector is much lower than the volatility from the 5-6 vector. For all intents and purposes, this means that buyers are picking the market up in a higher point than expected, which by itself means that buyers are increasing their power over the sellers. However, since the market is not that simple, in number 6 we have a piece of evidence that starts to contradict this whole scenario of buyers being dominant. In number 6 we have a fractal bar that clearly spikes the level of high number 4 with a significant degree of volatility. A fractal bar spiking a previous market extreme could be a sign of market manipulation. This is where the situation we had before starts to get a little ambiguous because the 5-6 vector with high volatility meant increasing power for the buyers, but once a fractal bar appears suggesting a market manipulation, the volatility of the 5-6 vector implies a von Riestorff effect, which is part of the market manipulation process. We have a few things to consider here. If we look at this chart without attempting to interpret all these events, we'll quickly arrive at the conclusion that number 6 represents the most important high, but that's incorrect in this situation. The most important high in this chart is high number 4 because this is the high that is serving as an axis for a potential manipulation happening in number 6. This is why it's counterproductive to start drawing pitchforks or lines without understanding the context of the market first. Right after low number 5, when price starts to pick up speed to the upside, retail traders start believing that buying the breakout of high number 4 is a good idea. Market makers understand that many retail traders think like that, so they can use this information to their advantage since high number 4 forms a cluster of buy stop orders. For market makers, a cluster of buy stop orders is nothing more than an opportunity to get in the opposite direction of the market, because if there is a lot of retail traders seeking to buy the market at one point, there can be a massive short position on the other side as well. This is a way for market makers to enter the market with a very large position and taking advantage of the fact that many retail traders attempt to trade using the simplistic breakout mentality. Another interesting detail here, now in the drawing domain, is that if we connect high number 2 and high number 4, we'll notice that it forms a 5-degree angle in relation to the x-axis of the chart. This might be useful in a technique called mirror lines, where we project the same angle with a negative sign in a low in order to predict an expanding pivot formation, which happens frequently in cases of market manipulation. We can project a line with a negative 5-degree angle to low number 3, and then we have a good projection for an expanding pivot formation. Here we can also take advantage of the fact that we already know that the most important high on this chart is high number 4, and not high number 6 because number 6 depends on number 4 in order to have its meaning in a way. Based on that, we can draw a pitchfork using high number 2, low number 3, and high number 4 in order to make a projection that correlates with the mirror line projection we just drew. A third line we can draw in order to support the hypothesis that high number 6 will be an extreme for buyers is actually a measurement of the 1-2 vector with a projection at the 3-6 vector. If we measure the magnitude of the 1-2 vector, we'll see that it's roughly the same as the magnitude of the 3-6 vector. Let's advance price a little bit to see what happens. Here we can notice that the mirror line projection with a negative 5-degree angle and the center line of the pitchfork do a good job of catching the next leg of the expanded pivot formation. That means this low is a potential candidate for a significant reversal point in the market. It's at this point that we can start looking for more subtle clues about the minor flow of the market. Notice that we have made projections on a larger scale dealing with the major flow of the market. Once we establish a good projection with multiple tools like we just did, we can start refining the analysis to look for optimal places to get in the trade. The fact that we made an apparently good projection for a downward vector in an expanding pivot formation means we have a long trade opportunity in hands if the correct clues appear. Observe also that we already have the possibility of drawing a frequency line on the lower tails of the minor flow that began to form after the center line of the pitchfork. A frequency line in a situation like this might be a good trigger for a long trade position if all of these conditions hold and if the minor flow displays a bullish quality for obvious reasons. So let's advance price a little bit more to see what happens. Here we can see that the projections we made about the vectors contained in the expanding pivot formation were correct in terms of accuracy and in terms of directional bias. The last thing I want to grab your attention to is the fact that if we draw a projection of this frequency line used to trigger the long position to the important high number 4, we'll see that price pretty much hits that projection on the upside. That could be a good place to put a take profit target order, for example. Notice also that the risk-reward structure here is very good. We have a small stop-loss order and a large potential take-profit order. These conditions are necessary to minimize the variance of your equity curve in the medium and long term. The hallmark of a good trade is its ability to produce a risk framework that diminishes the risk of ruin in the long term by minimizing the variance of the equity curve, which can be done by taking care of the risk-reward ratios in the case of price action analysis like this. That's it for this video. I hope you learned something new today. If you want to learn these techniques and much more in greater detail, check out the courses available in the video description. You can also visit my website fractalflowpro.com in order to see the table of contents of each course and the wall of YouTube verified testimonials from students all around the world. If you like this sort of video and wish to support the channel, please click the like button, subscribe to the channel, activate the notifications button, share the video with your trading community, and leave your feedback below in the comment section. Thank you very much for watching, and I hope to see you in the next videos. Take care.